Hello, I'm Mechelany from Mechelany Advisors FZE, and I'm talking to you today from our offices in Dubai, the beautiful city of Dubai, the financial hub of the Middle East. And I'm talking to you today to tell you more about what we do and where we come from and who we are. Mechelany Advisors FZE was created in 2010 in Geneva to provide independent research and research that matters. But let me first tell you a little bit about myself. I'm almost 60 years old. I've been in finance for 36 years, and I was very privileged to do three things in my career. I started in Paris, France, managing money for institutional clients, and actually, funnily enough, central banks and sovereign funds from the United Arab Emirates and the GCC region. Those days were the days of high interest rates, big returns on bonds. And during that period of time, I also ran our office in New York, where I had the privilege of not only catering for US pension funds, but also interacting with very fascinating people such as Michael Milken or Ivan Whiskey. And then moved to the second part of finance. I was recruited by Clymer Benson in London to run their equity arbitrage and market making operations on equity derivatives, warrants and convertible bonds, and those were the heydays of Japan, as you may remember. And after 5 years of running a high intensity business with more than 700 instruments traded around the world with teams in Tokyo, Hong Kong, Switzerland, London, and New York, I moved on to private banking and hedge fund management and institutional asset management, to the buy side, in fact. And I was extremely privileged to work with firms like Julius Baer, Barclays Bank, Union Bancaire Privée in Geneva. Then I became shareholder in a small bank called Heritage Bank, and then I was recruited by Bank of China to set up and run their Swiss subsidiaries. I'm actually, to this date, the only non-Chinese that has been a CEO of a Chinese bank. Now, this did not happen by accident. It so happened that in my career, I was extremely privileged to start going to the Middle East in 1984, in Japan in 1984. So I had the privilege of running a team over there at the time where the Japanese equity market was rising from 4,000 to 40,000. I also started going to Hong Kong in 1987, and I went to China for the first time in 1989, and that is before Tiananmen. And since then, I never stopped going to China. In fact, I started investing in China as early as 1994. And for almost 30 years, I have been going to China regularly. I had an office with analysts in Shanghai for 6 years, and I had the privilege to see the development of China firsthand over those decades that saw it transform into what it is today, the future leading economy of the world. And as I said, having been the only CEO of a Chinese state bank, the only non-Chinese CEO, I got very acquainted with the political system of China, the Communist Party, the way they function. And one of the reasons why they chose me to run their bank in Switzerland was because I had a very extensive experience of China, having visited probably most of the large state-owned banks, but equally a lot of small and medium-sized enterprises. Now, this lengthy experience in the financial world also gave me an insight on how asset management was performed, both by pension funds, but also for individual clients. And as you know, the traditional understanding of asset management is that you should have a balanced portfolios with allocations to equities, allocation to bonds, allocation to cash, maybe some commodities, depending on your age. And that management should be constrained within parameters like minimum allocation, maximum allocation that can change. Obviously, diversification, liquidity, quality, and reason. Now, when you do performance analysis and when you have been sitting on the advisory board of pension funds and so on, what you know is that every 10 years, equity markets take a very big hit. And it usually takes you 5 to 6 years to recover from those hits. Equally, in the past 15 years, we have been in an environment of extremely low nominal interest rates and low bond yields. So delivering performances is quite a challenging task when you are invested at all times in equities, in bonds, and cash. Moreover, we observed that the ideal performance for clients, the ideal performance objective is actually not to lose money. Yeah, it sounds stupid, but it is true actually. Not to lose money on an annual basis. And if you can't deliver 7% returns on average every year or more, you have extremely satisfied clients. And to do that, when I decided to end my career in 2010 in finance in big organization, I decided to create my own advisory firm, Mechelany Advisors in Geneva, and to implement an analytical process that is much more holistic than the traditional mainstream banks' analytical process. A research service that would give our subscribers very clean, simple, timed recommendations that they can implement in plain language with one only objective in mind, which is to allow them to deliver performances. And then we did something that nobody else does. We decided that it was all very good to show performances over the years, but it was much better to allow our subscribers to understand real time how we achieve those performances. In other words, putting your head on the block. In fact, if Mechelany Advisors is different from others, you could say that we say what we do, and then we do what we say. In fact, we implement each and every one of our investment recommendations in a model portfolio that you have access to, real time, that you can replicate, that you can use parts of whenever you want. And that tells you, shows to you how we have achieved our performances. And they're not negligible. Over the last 6.25 years, we have achieved 270% returns, and that includes a downdraft of the first quarter of 2020. At a time where the world equity index, the MSCI World, has delivered barely 11%. That's 1.7% per annum. And the reason why it has only delivered 1.7% per annum is because of those downdrafts. Now, when you make the difference between 270% return performances and 1.7%, it means that your portfolio has almost quadrupled over the past 6.25 years, while had you been passively invested in the MSCI World Index, your portfolio would have grown by only 11% over that period of time. This is what we call research that matters. And today, I was telling you earlier in the video that there are times where your investment advisors must have the courage to tell you, get out of an asset class, of a category of stocks, because the risk reward has become extremely unfavorable. And we are today precisely at this juncture. It may sound crazy. You may think we're crazy. But believe me, our analytical process is fully tested over the 1987 crash, the 1990 Asian crisis, emerging market crisis, the 2000 dot-com bursting, the 2007 crisis, where we actually predicted in advance that Bear Stearns and Lehman would probably go bankrupt. What we are saying to our investors today is bail out completely of US equities. I know. You don't like what I'm saying. Not only we're saying bail out completely of US equities, but we're saying bail out of the FANGs and Microsoft And actually, if you want to short them, you could even short them. Why do we say that? We say that because even before COVID, that very limited group of stocks of mega tech companies that are fabulous companies, don't get me wrong. I use Google, Apple, Facebook every day of my life. That's all we're talking about. And Microsoft. But their valuations have become untenable, and that was already the case back in 1988, 2018, and 2019. And with COVID, what we have had in this phenomenal rebound since March 23rd is a phenomenal concentration on very few stocks that are leading the indices higher, simply by fear of alternatives and fear of missing out. But we are in the most dangerous disconnect between the valuation of those equities and the reality of the fundamentals. Those companies will not be insulated from the lengthy, slow recovery ahead after the worst recession in 80 years that the world economy at large is going through. Facebook and Google rely for 80% of the revenues on advertising. Advertising is bound to go down. Apple sells computers, mainly iPhones. Their sales will go down and their profits will go down. Even Netflix and Amazon are going to hit earnings bumps. And the current valuations are just untenable. We are in the trend ending phase, vertical acceleration, melt up of this group of leaders that have been taking the secular bull market from 2008 to today to where it is. When they turn, due to their concentration representing more than 20% of the S&P 500, they will take the entire stock market down. And this could happen at any time. Don't try to be too clever. Protect your money. This is not a time to try to make an additional 1, 2, 5, or 10% when you have such a disconnect between the reality and the fundamentals. I can only encourage you to try our research service. And we have decided to offer you a freebie if you try. If you subscribe for 6 months of the service for barely $500 per annum, we will give you full access for a full year. That's a 50% discount from our normal prices. And you will be able to test our recommendations, and you will see, as you can just see, that we make bold recommendations because they're substantiated. And we're not worried and we're not afraid of being against the consensus, because this is what you need from us. Not to be with everybody else, but to tell you what to do at this point in time. I can assure you that with $10,000 of investment, you take any of our individual stock recommendation and you will more than pay for the service. A last little bit before I go. COVID is what is going to make China make a leap forward when compared to the rest of the economy. It would be too long to detail now, but we have written extensively about the superiority of the Chinese political and social system. We may not like it. It's not a question of, having a moral judgment. But what we're just saying is that for having observed it for 40 years, we can tell that they're more efficient, less leverage than the US economy. And they will recover quicker. And they are recovering with equity markets that are coming from a much lower base and valuation. And they will recover with the structural appreciation of the yuan. Once again, I invite you to try our services. It may cost you $500, but it will not be wasted, I can promise you. Have a great day and protect yourself and stay safe.